All right, let's talk about algorithmic trading. Today, we're going to break down exactly how machines are programmed to play the market, what makes them so powerful, and the very real dangers that come along with them. So, that brings us to the big question, doesn't it? Can a machine, a system built on pure, cold logic, actually outperform a world that's always been driven by human gut feelings, by fear, and by greed? To get to that answer, you first have to understand how the machine thinks. So, what are we really talking about here? At its core, algorithmic trading is just using math, data science, and code to automatically make trades on the stock market. It means a computer program, not a person, makes the final call to buy or sell, and it does it based on nothing but data and a set of predefined rules. And, the main reason for all of this, the primary function of an algorithm is to remove the single biggest liability in all of investing: us, our emotions. We've all been there, right? That fear that makes you panic sell at the very bottom, or the greed that convinces you to buy at the absolute top. Well, an algorithm doesn't feel any of that. It has absolute discipline. It just follows its programming with zero emotion. So how does the code actually do its job? It's basically a three-step process, and it happens unbelievably fast. First, it just sucks in massive amounts of raw market data. Then, and this is the important part, it sifts through all the chaotic market noise to find a very specific, actionable signal. And as soon as it finds that signal, step 3, it executes the trade. Instantly. We're talking milliseconds. So this signal, what is it really? Well, it's just a predefined rule, a trigger. For example, you could write a simple Python script that says, when the 50-day moving average of a stock's price crosses above its 200-day moving average, that's a buy signal. If it crosses below, that's a sell signal. Now that's a classic, simple example. Modern algorithms use way more complex signals, but the basic idea is exactly the same. Find the trigger, act on it, no hesitation. And this is where you see the mind-blowing advantage: speed and scale. A human trader might be able to watch, a handful of stocks, and it'll take them a few seconds to place a trade. In that same amount of time, an algorithm can scan thousands of stocks for its signal and execute thousands of trades. It's a whole different ballgame. But, and this is a huge but, what happens if the code is wrong? The very thing that makes the algorithm so powerful, its ability to just blindly follow logic, is also its biggest weakness. What happens if that logic has a flaw? See, an algorithm is only as smart as the person who wrote it. If the math is bad, or if the market does something completely unexpected that the code wasn't designed for, it's going to execute losing trades with the exact same brutal efficiency it uses for winning ones. The result? It can be absolutely catastrophic. An entire account can be drained in seconds. And this all leads us to the real takeaway here. The entire landscape of Wall Street has changed. The competitive edge isn't about having a good gut feeling anymore. It's about math. It's about programming. Modern Wall Street is run by data scientists and programmers, not traditional stockbrokers. The quants are in charge now.
Subscribe to Stick Market for more informative content.